Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Okay. Hi everybody. So there is a certain point. Okay. International economic is the last chapter for your course code. Okay. And maybe for other chapter, this is not the last code. Okay. Whatever it is, I hope that you can refer your course information based on your course code, your own course code. Okay, whether you are ECO 211, ECO 415, ECO 411. Okay. All right. So for this topic, okay, actually we are going to talk, and I'm going to explain you what is the international trade are. Okay. Before we going to the definitions of international trade, okay, we have to know what is advantage of every country doing the international trade. Okay, what's so benefit of international trade? So the first one is a benefit of specialization. Okay, if you are doing the international trade, means you are open your economy to other countries. Okay, example like before this, China, they are apply on the closed economy. It's mean that for their country, there's no export, there's no import. Okay, buying and selling just only on domestic trade. Okay, but now if you see, okay, China nowadays we call as a miracle of economic China. Why? Okay, because in the reality, the populations of the country was very high. Okay, and because of the very high population, they also have a child labor. And what's so attractive, okay, for every country to do investment with the China, okay, because of um, when we open the factory in their country, okay, the wage, okay, the wage for labor was very, very cheap. Okay, China and Indonesia is among of the country that was very attractive this foreign investor to invest. Why? Because of the wage was so cheap. As I said that, okay, until now they have a child labor. All right. Okay. When they open the economy, and now they are the third largest economy in the world. Okay. All right. They got the benefit from this international trade when they open the economy. The benefit of specialized mean every country they have their own specialized for production. Okay, what we can say that every country they have their own expert to produce some or certain product. Okay, maybe if they can specialize on that product, it's mean that when we open the economy, they can import the product that they produce. Maybe the price or the cost of production more cheaper compared to if the country there's no specialized on that product. Okay, the second is a benefit of economic scale. Economy of scale means if you can produce the product, okay, or good and services in the big scale, it means that you can minimize your cost of production. Okay, now when you open your economy, it means that your production not only focus on your country only, okay, but you also import your product. It means that there is a demand from other country. So this is what we call benefit of economy of scale. Okay, larger market, yes, of course. When you open your economy, okay, your consumer not only can buy the product from your own country, okay, but also, okay, we can buy from other country product. So it's mean the market was larger, and it's not good only for consumer but also for our seller, which is okay, they can market their product not only in one market but now it's a bigger or larger market. And the next is increased competition. Of course, increased competition. Okay, more and improved choices. Okay, this is a very good. Okay, and then transfer the technology and economic growth. Okay, as we know that Korea, Japan country, Singaporean country, and now China was one of the example country, and also US country. So this is what we call developed country or higher income country. Okay, so this is the country that we need them to transfer the technology, and if you are going to buy the technology, sorry to say that it's not cheap. Okay, so what we do is we are just depends on, okay, sharing the knowledge or sharing the technology. Example, let's say Japan. Okay, they do agreement with the Malaysia, so they are try to invest in Malaysia. They build a factory. Okay, but all the factory was conducted by the Japan. Okay, all the capital and so on. But the precaution here is, okay, the workers must from the Malaysia. Why? Why we just not take the labor from the Japan? Okay, because the objective is we try to transfer the knowledge and also transfer the technology. Okay, so the Japan have to train the labor from our country, and finally we can get the technology and also the knowledge from this country, which is developed country. Okay, Malaysia is developing country. Okay, I think you can read this Malaysian export and import. Okay, the data is from 2008 2012. Now, okay, you can just Google and search, you can get the 2020 data. Okay, all right, this is diversifications of export. Okay, the portion, and of course for Malaysian export is more focused on the manufacturing product. Okay, and then this is Malaysian import. Okay, we focus on the intermediate goods. Okay, this is a destinations of Malaysian export and import. Okay, this is just information, okay, for your knowledge. Okay, but we are not test this on the your test. Okay, this is a very important part. Barriers or restriction to free trade. Okay, all right. Uh, when we say the economy is open, it means that there is a globalization there. Okay, but every country they must have their own protection, because as we know that I think it's not fair if we try to, compare the developed country, because in this world we have developing country, we have developed country, uh, okay, we have low income countries, we have middle income countries. So if we put some batch, or uh, if we trade, okay, all this country in the same way, so it's not fair. All right, of course the developed country, okay, they have very high technology and they have their infrastructure is very sophisticated, and then we try to compare with the Malaysia, which is developing country, which is we are more need to them for transfer the technology. Okay, so as developing country or low income countries like Cambodia and so on, they need a protection. And not only Malaysia, but every country they have their own protection. So this is what we call barriers. Okay, so several types of barriers. We have tariff. Tariff is a tax. Import quota means we limit the quota for the import product. Okay, all right. And then embargo, we ban certain product. Volunteer export restrictions. It means that there's some direction from other country. Okay, you are volunteer. Okay, to restrict your export volume. And then the last one is a foreign exchange control. Okay. Sometimes in your test, okay, they will asking you about the argument for protection. Why we need protections? So this is a several of argument: infant industry argument, employment argument, national security argument, cheap foreign labor argument, anti-dumping argument. Okay, all right. So we go through with the balance of payment. What is a balance of payment? Balance of payment is a statement, is a record all final transaction between country and the rest of the world. As we know that when we do a international trade means we open our economy. So balance of payment is a record of your export and import. Okay? It's also provide informations about nation import and export. As I said, domestic residents earning from asset abroad, foreign residents earning on domestic asset, and give to and from foreign countries and official transaction by the governments. Okay, this is example for balance of payment in Malaysia. You can see that. Okay, the chart. We try to compare BOP between countries. Okay. Okay, when we talk the balance of payment, they have their own structure. Okay, they are divided by three. So we have current account, we have capital account, we have official settlement account. Okay, what is the effect of balance of payment deficit? In tests, they always asking you what is a effect or how to measure the balance of payment deficit, how to correct the balance of payment deficit. So this is a very popular question. Okay, effect. What is the effect? Effect is the impact. Okay, when your balance of payment deficit means your export is less than your import. So what happened to your country? Okay, the first one is a lower economic growth. You spend more. Okay, your flow of money out is more than flow in. So this is not good. Okay, and of course increase indebtedness. Okay, depletions of official reserve. Okay, and then contractionary effect. And the last one, this is the popular one, devaluations of domestic currency. This is not good. Okay, the value of our currency is too small. There is a several method to reduce the balance of payment to be deficit. First, okay, if you see sometimes the government stimulate or encourage you to export the product to other country. Okay, but they are restrict the import. Okay, they are restrict our consumer to buy import product. Okay, they encourage now buy a domestic product. Okay, and then we have to reduce import. Okay, because of deficit means import is more than export, and we have to reduce the aggregate demand and attract the short-term capital inflow. This is what we call investment.